First the banking crisis, then the credit crunch, and now the recession. The inevitable has finally happened. The banking crisis has caused a significant drop in lending from U.S. banks. As banks continue to withdraw more and more of their customers' money, they are becoming increasingly hesitant to offer new loans, particularly the regional banks that are already under pressure. As a result, the banking crisis has led to a credit crunch, which in turn has resulted in a recession. This is a logical consequence as the avalanche set off by the banking crisis is now cascading down into the valley. The lending of U.S. banks fell by a record $104.7 billion in the last 2 weeks of March, which is the most substantial decline ever reported by the U.S. Federal Reserve since 1973. This significant decrease in lending highlights the tightening of credit conditions after several high-profile bank failures that could harm the economy. In the latter half of March, there was a broad-based decline in total lending, including housing loans and commercial and industrial loans. The Fed has also reported that commercial bank deposits decreased by $64.7 billion in the last week, which is the 10th straight decline primarily due to a slowdown in lending to large companies. The decline in lending follows the collapse of Silicon Valley Bank and Signature Bank, making the consequences of the banking crisis more apparent: a massive credit crunch. Economists are closely monitoring the Fed's so-called H.8 report, which contains an estimated weekly aggregate balance sheet for all commercial banks in the U.S. to gauge credit terms. The recent bank failures have hindered the central bank's efforts to reduce inflation without plunging the economy into a recession. The index of credit conditions fell on Thursday at the American Bankers Association to its lowest level since the pandemic began. Bank economists anticipate credit conditions to deteriorate over the next 6 months. As a result, banks are likely to become more cautious about lending. Jamie Dimon, the CEO of JPMorgan Chase & Company, has stated that the banking crisis has made a recession more likely. In his annual letter, he said the defaults have severely unsettled the market and will clearly lead to a tightening of financial conditions as banks and other lenders become more conservative. The Fed's report shows that lending at the 25 largest domestic banks fell by $23.5 billion over the past 2 weeks, while lending at smaller commercial banks fell by $73.6 billion over the same period. Foreign institution lending in the U.S. fell by $7.5 billion. The 25 largest domestic banks account for almost 3/5 of lending, although in some key areas, including commercial real estate, smaller banks are the primary lenders. In the week ending March 22, domestic banks sold $60 billion worth of loans to non-banks, which means that these loans are no longer held by commercial lenders. Meanwhile, so-called other deposits, which exclude large-term deposits, are down $260.8 billion at commercial banks since the week ended March 15. At domestic banks, they fell by $236 billion, primarily due to a decline at the 25 largest institutions. Deposits at small banks fell by $58.1 billion. Here is a summary of the changes in the last 2 weeks. Commercial and industrial lending fell by $68 billion. Commercial real estate loans fell by $35.3 billion. The total value of assets, including vault holdings and deposits at depository institutions and the Fed, decreased by nearly $220 billion. Total liabilities fell by more than $188 billion. If this trend persists, it is likely that we will witness a substantial number of companies filing for bankruptcy, leading to a corresponding increase in unemployment rates.
Thank you for watching. Don't forget to like and subscribe for more great content in the future.